This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Understanding company fundamentals, the why behind a stock price move certainly matters, but trying to divine the cause of broad market moves is probably a waste of time. The what is more essential than the why. Up next, we need to know the difference. Let's take stock. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. You know, this isn't my first rodeo. I came into the business in fall of 1991, believe it or not. I've been through a lot of downturns, both recession-oriented downturns like the dot-com bubble, COVID, financial crisis, but also a lot of other 15, 20% type drawdowns that were not necessarily correlated with recessions, but painful nonetheless. I bring this up because obviously the catalysts, the why behind certain downturns changes every time, right? We've gone from credit crisis to health crisis to tariff crisis and everything in between. People focus 90% of their time trying to figure out the why. I'm not saying it's not important, but it's a bit of a waste of time if you're an individual investor. Much more important to figure out the what. What is actually happening? Because yes, even though the catalyst, the causation may be different each time, the market patterns, the market behavior, how to sort of interpret what other investors are doing, investor sentiment, those things are remarkably consistent. So we can certainly draw from other downturns to inform the present. But again, if you read the headlines, 90% of it is focused on the why, very little on the what. Let's make sure we prioritize what is actually going to help you as an individual investor. So what do we know? Well, we know a number of things, right? We know that market corrects roughly 5%, 2 to 3 times a year, 10% roughly every year or two, 20% once every 4 or 5 years. That hasn't changed. The average drawdown, according to FactSet in the S&P 500, going back to 1928, is 16.3%. Well, when we hit the low a couple weeks ago, who knows if it's the low or not, but at least the low for what we've seen so far, we were down about 19%. So as painful as the last few weeks have been, as unprecedented as some of the headlines have been, of course, related to tariffs and Trump and what have you, the pattern, we've seen it a lot. Okay, in fact, it's almost, dare I say, typical. I know doesn't sound like that's the case because we've been in a relatively low volatility environment for most of the past decade, with a few exceptions, 2022, 2018. But yes, this is typical. And guess what's also typical? Recession. Going back 170 years, by my math, when I look at long-term charts, we've had a recession about once every 5 years. Pretty routine. Now, in recent times, of course, we have not, right? In the past 15 years, we've only had one recession, which lasted, 2 or 3 months? Maybe it was only 2 months. Of course, that was the COVID crisis in 2020. So maybe we're all a little bit out of shape economically, for lack of a better phrase, right? And as many people as there are now calling for a recession, I got to tell you, I remain skeptical about people's ability to forecast that, right? I mean, just a couple years ago, everybody was calling for a recession. I mean, J.P. Morgan, Jamie Dimon was talking about us going into recession. There was a survey, it was a Bloomberg economist survey, where they surveyed the quote-unquote top 60 economists, whatever that means. They priced in, or at least they forecasted, 100% odds of recession in 2023. 100%, 60 for 60. And numerous others did the same. And of course, that never happened, right? This was when rates were going from 0% to 5%. All historical precedent pointed to the fact that we'd undergo a major economic slowdown. Again, never happened. I'm not saying that we won't go into recession this time around, but I certainly take those forecasts very much with a grain of salt. What do we also know? Well, since 1950, according to Charlie Bolello at Creative Planning, the average bear market recovery time, so this assumes a drop of 20%, or more, which we were very close to the other day. So since 1950, the average bear market recovery time, and by recovery we mean from the low to a new high, okay, so exceeding the high for the S&P that was set in mid-February. It's been about 14 months. That's been the average. The longest was 48 months. So you have to expect in this environment that we may not get a V-shaped type recovery like we did in COVID, where you had an avalanche of stimulus coming in. Of course, the vaccines came out. That doesn't feel likely this time around. It might be more of a grind. But, if we're somewhere around the average, if it took a year plus to get back to where we were in February, is that the worst thing in the world? I don't think so. And the average stock might take a lot less, right? Remember, we've had some pretty big drawdowns in some of the higher multiple tech names at the top of the S&P. The recovery time may be a lot less for some names that were not as stretched, trading at more reasonable valuations. So I just want you to think about that. I also want you to think about the fact that no matter what you're doing, sometimes you just lose money. And I know that sounds a little bit callous, maybe, but again, I read something from Nick Majuli. He looked at diversification, and I won't get into everything that he kind of wrote, but he looked at a model portfolio that a lot of Americans have, which is a weighting in a home, real estate, U.S. stocks, gold, not everybody has gold, but some people do, 10-year treasuries, and real estate, commercial real estate, REITs. Okay, so home, U.S. stocks, gold, treasuries, REITs. All right? And the only reason I bring this up is he looked at the quote-unquote optimal portfolio for every time period. In other words, given the performance of those different asset classes, where was the best place to be positioned? And what he found is even, and this is going back to 1950, even if you had the optimal portfolio, the best possible weightings in those various asset classes, you still lost money. Still lost money once out of every 4 years. Think about that for a second. Then he went back to 1972. He found that in only 7 out of 53 years, were there periods where all 5 of those made money at the same time. So most of the time, even if you're properly diversified, you can, put up a vague term, but optimally diversified across various asset classes, even if you did all that right, you probably still have something that isn't working for you at any given time, and you still lose money once in a while. So I'm not being fatalistic here and saying that this is going to be a terrible year and we'll never make money. I'm not saying that. I don't know what the next 7-8 months have in store. But I do know that sometimes you just don't make money. And quite frankly, we're coming off of 2 really good years where I don't want to say most because I can't speak for all investors, but a lot of investors probably had double-digit returns over the past couple of years. Okay? So keep that in mind. All right, enough of that. Let's focus on kind of the what, right? What is actually happening in the markets? What's that old expression, life comes at you fast? Well, just a few months ago, people were talking about Trump being the biggest pro-business, pro-stock market president ever. I mean, I won't read the headlines to you, but I can recall numerous headlines from hedge fund managers, market strategists saying exactly that. Well, the reality is, if the current trade policies keep up, which is a big if, by the way, but let's say they do, that's going to be bad for the global economy, supply chains, profit margins, consumer prices, and corporate earnings. There's no sugarcoating that. That's not pro-business, nor is that pro-stock market. Now, this is not, please keep in mind, I'm not making a comment on what Trump's trying to do. Okay, I understand he has a certain idea of what he wants to do in the global economy and also in terms of onshoring or re-onshoring some of our manufacturing base. This may all work out, so I'm not necessarily critiquing what he's trying to do. I'm just saying in the short term, you cannot sugarcoat the reality that he's not a pro-business president and pro-market president, at least for now. Is what it is. The only other reason I bring this up is, and I've mentioned this a number of times, particularly around elections over the past 20 years or so, maybe, almost 20 years. And that's, please do not conflate your politics with your positioning in the markets. It's really dangerous. And it's been dangerous this time around. If you loaded up on stocks in November and December thinking that, Trump was going to have your back, well, we've seen what's happened. I mean, the greatest example of this is U.S. small cap stocks. Right after the election, they had a double-digit spike, thinking that Trump was going to be great for companies that are primarily domestic. International stocks went the other way. Since then, we've had literally the polar opposite trade. Small caps are down in the mid-teens this year, so close to 30% from the highs in November. Meanwhile, international stocks, for the most part, have significantly outperformed U.S. names. So again, just to be clear, I'm not bashing Trump. That's not where I'm going with this. I'm just making the point that if you have kind of blind faith in a leader of any type, Biden, Obama, Bush, Trump, and align your portfolio positioning with what you think could happen, very dangerous. And it can shift multiple times within the presidency. Market could be doing great 6 months from now or a year from now, based on policies that we haven't even seen yet. So just keep all these things in mind. I want to talk a little bit about sentiment. One of the reasons that a lot of individual investors do not do well is they're chasing yesterday's headlines, right? In other words, we're 6 months into a downturn or 3 months into a downturn, and that's the time that you decide to start getting negative and cautious and conservative. And the reason I bring this up today is the sentiment across the board from a number of different perspectives, which I'll get to, are about as negative as I've seen in a long, long time, which does not mean that there isn't risk going forward. Doesn't mean that things can't get worse. We all know they can. But you have to wonder how much negativity is already baked into the cake. How much is already discounted? So, for example, I read from Schwab just this week that even though the S&P 500 is down high single digits for the year, the average stock in the S&P is down a little over 20% for the year already. Okay, so the average stock in the S&P already in bear market territory. In fact, Larry Adams here at Raymond James said something similar. He found that, and this is as of about a week ago, might be a little bit better now, but as of a week ago, 2/3 of the names in the S&P 500 were down 20% or more. Okay, so lots been discounted already. We've talked a lot about, and you continue to see headlines to this effect, the sort of end of U.S. exceptionalism, the idea that we're the best place for capital flows, the best place for investors, that's over. Again, I would push back on that. I know that's been the short-term narrative. I doubt very much that will be the longer-term narrative. But guess what? The U.S. dollar has seen its worst 2-month plunge, according to FactSet, since late 1987. Almost 10% down in 2 months. So the dollar, the currency, is already pricing in a fair amount of angst, for lack of a better word. In fact, this combination of stock, currency, and treasury weakness hasn't been seen since the early 80s. When Reagan first came in and had to deal with a recession before things were kind of started to head in the right direction. So can it get worse? Of course. But not just the stock market, but bonds and currencies are already reflecting the potential, I think, for not only sea change in policy, but also certainly a slowdown in the U.S. economy. We're seeing in the business community. If you look at the New York Fed Business Leaders Survey, it plunged 25 points last month. And then the future business activity sank another 23 months for its lowest reading since April of 2020, which was right when the tech bubble was blowing up, right, as dot-com stocks were melting down. So the survey basically indicates that firms are expecting a significant decline in activity in the coming months. And then we've seen broader measures like the IMF came out recently. They lowered their global GDP, not only global GDP, but also GDP in almost every developed country. So the important point is this data has not been seen yet, right? The current data is still pretty darn resilient. This is economists, business surveys, sentiment surveys, getting out in front of the data, looking well beyond the current environment to what could be happening over the next sort of 6 to 12 months. So again, that doesn't mean that it can't get worse. It just means that if we do get bad economic data, it's not going to surprise anybody. Remember, it's the things that really surprise you that generally had the biggest market impact. To wit, a couple of weeks ago, when Trump unveiled his tariff policy, we had such a negative reaction because it was a much more draconian tariff policy than what anybody had modeled for. It's those things that, it's not the things that everyone's talking about that generally cause the biggest market movements. Same thing if we look at investor sentiment. And I'm not going to belabor the point here, but there are a lot of different ways to measure that. But I've talked a lot in the past about the American Association of Individual Investors Sentiment Survey. Well, it just registered more bears than bulls for the 8th week in a row. Get this, this has never happened. Going back to 1987 when the survey came into existence. Has never happened. So this is worse than the dot-com bust, the global financial crisis, COVID, 9/11, worse sentiment than in any of those periods. And then, lastly, Wall Street itself is getting more negative. If you look at all the various year-end 2025 Wall Street strategist targets, for the S&P 500, on average, according to Strategas, they've declined by about 700 points just since January 1st. So, I think the point's pretty clear. Point's pretty clear that a lot of negativity from just about every angle has been baked in. Well, what does history say about sort of performance when this happens? Well, I think it's sort of interesting. So going back to that AAII, American Association of Individual Investors, according to Bloomberg, whenever you've had this level of spread of bears over bulls, it's been very favorable for the S&P 500 over the coming 12 months, with a couple exceptions. One was 9/11. The second was January of 2008, where it got a lot worse before it got better. So it's not a fail-proof indicator, but most of the time when you had this level of pessimism leads to better results going forward. Same thing if you look at the VIX, VIX, which is a measure of market volatility. When you get these types of levels, also according to Bloomberg, above 35 and 40, which is what you've seen several times over the past couple weeks, on average, going back to 1950, you've had a 12.7% positive move in the S&P 500. There's a great quote I just saw this week from Jim Chanos, the famous hedge fund manager. He said, in bull markets, people put a premium on promises, and in bear markets, they put a discount on reality. What does that mean? Basically means when things are good, people extrapolate it out into the future and overpay for future good news. In times like this, when there's a ton of negativity, they actually underprice reality. Last thing I'll point to is some work from Ritzold Asset Management. They looked at periods going back to 1950 when we've had a 15% drawdown. And as I mentioned, we hit close to 19% a couple weeks ago. Well, the forward returns from a 15% drawdown were pretty good. On average, again, this is since 1950, 1 year, 15% for the S&P, 3 years, this is cumulative, 40%, 5 years, 66%, 10 years from that 15% drawdown, almost 186%. And yes, there are a couple outliers. I think the dot-com bubble is probably the biggest outlier because that took a much longer time to recover. But still, on average, when you have these types of sentiment conditions, volatility conditions, and even performance conditions, chances are forward returns are better, not worse. And I know that sounds a little bit obvious, right? When things are low, they have a better chance of going higher at some point. So I know it sounds obvious, but most people don't think that way, right? In fact, most people think the opposite way, that if things are going poorly, that things are going to continue to go poorly and get worse. That's why most people sell at the bottom rather than at the top. And just a couple other things I'll mention. If you think recession is coming, and the odds are probably a coin flip if you believe the betting markets, but let's say you do think a recession is coming, just remember that most of the time a recession is declared well after everybody knows that we're into a slowdown. And also remember that the markets generally react way ahead of time as well. So, for example, back in 2008, you may have forgotten this, but the National Bureau of Economic Research, they did not announce that a recession had started in January of 2008 until December. It was 11 months after the market had started declining that a recession was announced. So if you're waiting around for that signal, chances are the market's already moved significantly. And then, of course, the corollary to that is that generally, in almost every environment, the stock market bottoms well before the economy does. Okay, and the prime example of that was also the financial crisis, where the market bottomed in March of 2009. We were still in recession, getting terrible economic news until well into 2010. I remember it because I lived through it, and many of you listening lived through it as well. My guess is, and this is just a guess, I'm not in the prediction business, but that my guess is, looking at other, COVID, dot-com, financial crisis, other, very tough periods for investors, that kind of waterfall period where we had those 5, 6, 7% declines, we had 10% in 2 days, that could be behind us. Okay, that could be behind us. No guarantees of that, but it could be behind us. But what generally follows when you have sharp declines like that is you have a sort of a period of frustration, if you will, a grinding period. Strategists calls it a workout phase, where you have some pops, some rallies like we did this week, but where you also have some what they call retests. In other words, when you hit a low, the market often probes that low multiple times before finding a base that people find is a sustainable base for the markets. That's a frustrating period because it's easy to get sucked in. Oh, market went up 1,000 points. I'm going to go back in. And then, the next week you're down 1,000 points. And often, bearish sentiment gets actually more pervasive. And I think it's because people are frustrated. If you see the market rally 3 or 4 times and then sell off 3 or 4 times, very easy to just sort of, oh man, this is never going to end, throw in the towel. But what often happens is those retests, as I've said, often happen on lower volume. In other words, a lot of the selling pressure, particularly the leveraged or the deleveraging, that massive selling pressure when hedge funds are overstretched and leveraged investors are overstretched, that you're exhausting that selling volume. And again, you finally get to a point where the market can stabilize. Obviously, I have no idea where that point is. I do not know if bottom a couple weeks ago was the bottom for this cycle or whether we're going to hit new bottoms. But my guess is, particularly with some of the news this week, that maybe some of the worst case scenarios, I don't want to say they're off the table, but those risks have been reduced. So if there was the risk that Trump was going to fire Chairman Powell, I think that's less likely now. Both Scott Bessent, Treasury Secretary, and Trump suggested that the China tariffs will be walked back to some degree from where they are today. So there's certainly risks. I am not making light of those. I'm not being Pollyannish at all. But some of those real draconian, doom and gloom scenarios may not be as top of mind, if you will, as what they were a couple weeks ago. So that's why I said maybe some of those waterfall selling periods are behind us, but doesn't mean we're out of the woods by any stretch. We're going to have some tough days. So just keep that in mind. And the Fed is smart enough to realize that some of the current economic data may be a bit of a mirage because so much activity was pulled forward. I mean, Apple, for example, they were shipping boatloads, literally boatloads of iPhones the last couple weeks just to get ahead of the tariffs. So there's a lot of stockpiling of inventory, probably individual investors too, consumers stockpiling things that they know are going to be more pricey. We've certainly seen that just anecdotally in my neighborhood. I know 2 neighbors who bought cars because they don't want to pay more, 6 months from now, foreign cars. So the current data may be misleading, but the good news is, going back to what I said about sentiment, that a lot of that projected bad news may be already priced in. Okay, so this is something obviously we'll be monitoring. I just want to say a couple other things briefly. Of course, the other big sort of news flow is we're getting first quarter earnings. And I actually have welcomed first quarter earnings because I'm so sick and tired, I'm sure you are too, of just reading political headlines and Elon Musk headlines and tariff headlines. It's great to actually hear from companies. And it's interesting because companies have taken a lot of different approaches. Some have kind of issued worst case scenario outlooks about tariffs, which maybe has led to a stock price dip, but I think analysts appreciate the transparency or at least the credibility of that. Others, I've actually heard some companies not even bake any tariff impact into their guidance. Obviously, I think you have to be very skeptical of that type of earnings release. And then there are others who have attempted to quantify with some degree of specificity. So companies have taken different approaches, but at the very least, it's very good and instructive, I think, to understand how companies are thinking about the current environment. I just make a couple key points in general. One is stocks are not the economy. I actually think that earnings will hold up better than economic growth. And a lot of the reason for that is companies came into this sitting pretty well. Corporate profit margins were at an all-time high as recently as 2 or 3 months ago. And so as a result, a lot of companies have positive operating leverage. They've adjusted their cost structures, strategic layoffs. They've invested in new equipment, of course, taking advantage of AI. That means a lot of companies, not every company certainly, but a lot of companies have levers that they can pull even when there's significant threats to their margins with, from tariffs or even a slow top-line sales environment, in a slowing economy. So I actually think that earnings will not decline as quickly as potentially revenues could in a slowdown scenario. The other thing I would say is I mentioned the very sharp drop in the dollar earlier. Well, a lot of the companies that we invest in, and certainly a lot of the companies in the S&P 500, do a lot of business overseas, right? Well, a 10% drop in the dollar, that makes the value of those foreign sales that much more. So again, I know the dollar is dropping maybe for reasons that aren't that great, It's sort of a loss of confidence in, at least temporarily, in what we're doing here in the United States. But still, the end effect could be that the dollar drop could offset, some of the tariff risks. The other thing I would just say is be very careful, particularly if you're an individual investor, screening stocks to see where you might want to put some money. Be very careful relying on price to earnings ratios right now. And the reason is pretty obvious. You can't trust the E in the PE ratio. I mean, who knows what earnings are going to be? So if you've seen a stock that was at 25 times earnings and now it's at 20 times earnings, you might say, man, this thing looks cheap. But what happens if the E drops by 15, 20%? It's probably expensive, probably more expensive than it was a few months ago. So I'm not saying you shouldn't pay attention to valuation. Of course we do. But you also need to pay a lot of attention to the resiliency of those earnings. How likely is it that the E is reliable? And that's why these earnings reports are very instructive, because you need to have faith that management is being credible about the tariff impact, offering some realistic scenarios about it. So just keep that in mind. I've used the term grain of salt several times on this podcast today, but I think it's a very appropriate way to think about price to earnings ratios. So up next, along those lines, I do want to comment on a few of our names who've reported so far. There's a lot more to come, so I'm sure Chase and I will have more individual stock discussions here over the next couple of shows. But up next, stick with me. I do want to highlight a few. Back in a sec. Almost everything that lagged last year, value, international, and more defensive stocks, have held up relatively better here in 2025. Is this just a knee-jerk reaction or a more sustainable trend? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc. the WISE Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
As promised, I just wanted to comment briefly on some of the names who've reported that we own for a number of our clients. And remember, as I always say, the names I'm going to discuss are companies that we do own for a number of our clients. And if you are a client, I think you can feel confident that we've done our due diligence and determined that they are suitable for your portfolio. If you're not a client, remember, you have to do your own research, your own due diligence to make sure that's the case. Also, all the names that I'm about to comment on are names that I own personally in my own portfolio. I like to eat my own cooking, and you can consider that a conflict of interest. So one thing I'll mention is we just started nibbling in a number of portfolios, and we'll use price volatility to probably do more, on NVIDIA. You know, a lot of our clients over the last 6 months or so have wondered, hey, why the hell do you not own NVIDIA? You know, it's been doing so well. Why do you not have it in the portfolio? Well, the valuation was really demanding, and we felt the risk-reward trade-off for much of the last 6, 7, 8, 9 months was not particularly favorable. And of course, the stock has responded with almost a 40% decline so far this year, okay? But at these levels, I think NVIDIA is interesting to take a look at. And when I say, I use the term interesting because it's impossible to know whether it's truly cheap, right? Because we don't know what the earnings are going to be when there's so much uncertainty with respect to their business with China and the tariff outlook overall, not to mention the return on investment from AI in general, which is also being called into question. So very difficult to say that the stock's cheap, but I will say this. If you believe their earnings, or that their earnings are somewhat close to what they should be, they're now trading, according to FactSet, at a forward price-to-earnings ratio of a little over 20. That is a slight premium to the S&P 500, but if you take a step back, that is the smallest premium they have captured going all the way back to 2016. And back in 2016, that's when their sales from gaming, video games, were 10 times their data center revenues back then. So it was a completely different company. It was not an AI company in 2016. So at least on a relative basis, I think it's fair to say NVIDIA is cheaper than it's been in almost a decade relative to the S&P. But we're not naive to the risks. There's a lot going on there. It was just announced the other day, a couple weeks ago, that the U.S. government will now require a license to export previously compliant equipment to China. And the company basically took a $5.5 billion charge on that, with the assumption, at least from an investor perspective, that they won't get that license. So their China business, extremely compromised, and quite frankly may not even exist unless they can work out some kind of an exception, either with the China government directly or with the U.S. government directly. And to that end, there's a lot going on there. I know a group of Republican senators recently went to Howard Lutnick, the Commerce Secretary, and said, hey, listen, we're in danger of losing our AI technology superiority to China. So you can't rule out some more favorable policy, either tariff-related or regulatory-related, towards NVIDIA and other chip manufacturers. But in the short term, you really have to discount a lot of those sales. I would argue that the current price-to-earnings ratio that I talked about a minute ago incorporates a lot of that. These issues are widely known. So we're not hubristic, if that's a word. I don't think it is, but I'll use it anyway. We're not hubristic enough to think that at these levels it will be the bottom, so that's why we're nibbling on it. But I think NVIDIA is interesting to consider here. I'm not going to get too much into their fundamentals. I'm just looking at the valuation from a FactSet perspective. Raymond James talked about that Lutnick meeting with the Republican senators. So I'll follow what Raymond James and others have to say about any developments on that front. But might be worth considering here, but the risks are substantial that it could go lower. So I think you have to be careful with how much capital you deploy there if you are considering adding NVIDIA at this point. AT&T, I think, is very interesting to consider as well. Of course, AT&T has been considered sort of a boring name for a long time, but it's pretty clear from their recent, really the last couple of quarters, but this quarter in general, or this quarter specifically, I should say, that AT&T is starting to execute on a fundamental basis much better than they have in a long time. According to FactSet, not only did they beat analyst estimates on the bottom line and the top line for this quarter. But the most important thing, and I didn't really care that much about that, but what I really keyed on with their quarterly results is they added over 300,000 net phone subscribers, okay? Over 300,000. And importantly, those have been mostly bundled plans. In other words, these are people who have, fiber and, mobile contracts. So they are capturing a greater wallet share from their customers. And in fact, Raymond James analyst said something similar. He said this week that they're achieving what they call 40% mobility sell-through on fiber customers. So it basically means that their existing landline fiber clients like me, I'm an AT&T customer, about 40% of those are also using cell phone plans, which is a pretty significant number. And if you kind of do the math there, and look at the average turnover in those contracts, that adds a lot of potential stability and transparency to AT&T's numbers going forward. There were some other things that sort of interested me about their quarter. One is that for the first time in a long time, they talked about buying back some stock, maybe buying back as much as $20 billion in stock over the back half of this year. So there's some things going on there with AT&T that have not been really the case over the last couple of years. And I'm not really going to comment on Verizon here on this podcast, but it does look like they're picking up some market share from Verizon. Now, I will say on the sort of cautionary side, they're not as cheap as they used to be. And a lot of that's just because the stock has held up pretty well. They used to be a single-digit multiple. Now they're a low double-digit multiple. And the dividend yield's not as high, again, because the stock price is higher, yielding about 4%, used to be over 6%. And they are not without tariff risk, right? I mean, if Apple has to raise the cost of phones and other carriers have to raise the cost of phones, AT&T is going to have to pass that through to customers. They think because their contracts are longer, 3 or 4 year service contracts, that they can spread that cost hit out for customers over a long period of time. They don't think it will be, at least according to the Raymond James analysts, that it'll be a big deal, but they do have tariff impacts. So anyway, take a look at AT&T, though. If you're looking for a company that's almost entirely domestic, not subject to a lot of the whims of foreign customers, they do have risks, but may be interesting for you to take a look at. I just want to mention a couple others. I've mentioned Danaher numerous times over the years. They're a diversified life sciences company. They have a lot of China exposure. They also have a lot of exposure to drug development, right? They synthesize proteins that are used in drug studies. So they had a big flurry of demand during COVID that really dropped off post-COVID. And of course, there's sensitivity there to NIH cuts, Kennedy Jr., the FDA taking a more skeptical view towards a lot of drug development. So there's certainly some risks. But if you look at Danaher's most recent quarter this week, a lot of positives. Goldman Sachs was actually quite positive on the quarter. They noted a book-to-bill ratio, which is a ratio of new business relative to existing business that was expanding. They beat on the top line. They beat on the bottom line. Most importantly, people are really focusing on bioprocessing because, again, that's the business that's probably most sensitive to China, tariffs, U.S. policy towards drug development, which I just mentioned. That they actually raised their guidance for the bioprocessing over the course of this year. They also quantified their potential tariff exposure. They actually put a number on it and articulated a pretty concrete plan to mitigate that additional tax through cost savings, supply chain adjustments, pass-throughs. So I think Danaher was able to present a very credible front on how they're going to tackle this environment and probably, according to Goldman Sachs, were conservative, quite conservative in terms of their earnings guidance. Stock's not cheap. It never has been. That's probably the biggest risk is just the multiple. I mean, they traded over 26 times earnings, so there is not a huge safety net there. But if they can execute credibly, I've used that word a few times, but I think it's a good word. If they can execute credibly in this environment, and they don't have to knock the cover off the ball, they just have to execute, I think the stock could be interesting for you to consider here. Last one I wanted to mention quickly was a major disappointment, just to be very candid. That was United Health. To be honest, delivered a bombshell the other day. What was very frustrating about United Health, it's obviously been a very tough year for United Health on a number of fronts, right? We all know that. But the bombshell was that as recently as December, they had reaffirmed their earnings guidance at an investor conference. And I think Wall Street in general, the Raymond James analyst included, felt pretty darn comfortable about the earnings targets. Well, they come out with their earnings the other day, and not only did they miss earnings, they significantly lowered their guidance. And it all came from one area. It's their Optum Health business as it relates to Medicare Advantage. That's where all the problems were coming from, and the problems are actually pretty simple. More people are getting treatment. I know that sounds weird, kind of a weird way to put it, but many more, particularly seniors, took advantage of going to the doctor, essentially, than what they had modeled for. Now, I don't know the reason for that, but that's what happened, and it surprised them, and they had to lower their guidance. So the bad news is stock took a good hit, which was quite unfortunate because it actually had been holding up well. United Healthcare was up 15% for the year going into the release, so they've gotten hammered since then. I think the more positive news is that particularly the Raymond James analyst thinks that this is a 2025 issue, and it's likely to not be recurring in 2026. And the combination of updated risk codes, a healthy rate increase, Medicaid pricing catching up, and some other things should lead to a more favorable environment. And I think the other piece of decent news is the multiple now is quite cheap relative to experience. In other words, they're trading at about a 5 percentage point discount to the S&P versus a 5-year average of trading at a premium to the S&P 500. So, it was a painful couple of weeks for UNH investors, particularly given their outperformance coming into it. But remember, this is a company that is entirely domestic, really doesn't have any tariff exposure to speak of. Yes, they have exposure to employment, people losing their insurance because of layoffs. So they have some exposure there, but they don't have the tariff and global trade war exposure that maybe some other healthcare companies do. And I do think stock may be worth taking a look at here as long as you're comfortable with what is sure to be volatility. So keep an eye on it. It's been a disappointment in the last few weeks, but keep an eye on United Health. The last thing I will say, and then I will let you go, is there's some really interesting things going on in the bond market. Because you had so many forced liquidations, panic selling over the past few weeks, corporate and municipal bonds have come under a lot of pressure, particularly municipal bonds, because in many cases they're very thinly traded. I'm not going to get into a lot of specifics today. Maybe I will next time I host. But you're now seeing, if you're willing to go out 10, 15, 20 years in high-quality paper, single, double, AAA paper, you're seeing tax-free yields, federal tax-free yields in the 4 to 5% range, which if you're in one of the high brackets, or let's say you're in the max bracket, that can be equivalent to as much as 7 to 8% on a taxable investment like a treasury or a CD or money market. Think about that for a second. We're not talking about speculative paper. We're talking about high-quality investment-grade paper. Now, you have to go out a number of years to get those yields. You have to be willing to buy something with a 10, 15, 20-year maturity or call date. But, 7 to 8%, that's probably, that could very well be better than what the S&P 500 delivers annualized over the next 10 years. Obviously, I have no idea, but wouldn't shock me if the S&P did less than 7 or 8% annualized over the next 10 years. So, I'll talk about this probably on another show, but if you're sitting there with money to allocate to fixed income, there's some really interesting opportunities to consider. And again, I'll get more specific probably next time. Hope that was helpful. I know I covered a heck of a lot of ground. As promised, I'm sure Chase will have more to say on the individual stock front. We have a lot of names reporting over the next week. Until next time, as always, stay healthy, and I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the WISE Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.